$850 billion is not just a statistic you scroll past on a financial news ticker. It is pressure. It is weight. It is a silent force pressing down on the foundation of the global financial system. And right now, that pressure is being applied deliberately, methodically by China. This is not a theory anymore. This is not a what if. This is happening in real time, and most people are still asleep because they've been trained to look in the wrong direction. They are watching the stock market, watching inflation prints, watching what the Federal Reserve says in press conferences, while the real battle is being fought in the shadows of the bond market. And the bond market never lies. It doesn't care about optimism, narratives, or politics. It only cares about math, and the math is breaking. For decades, Americans were told that the bond market was boring, safe, almost irrelevant to daily life, something only pension funds and governments worried about. That was a lie. The bond market is the spine of the entire system. It sets the price of money itself. When that spine cracks, everything built on top of it starts to collapse. Housing, stocks, banks, jobs, retirement accounts, all of it depends on this one market functioning smoothly. And now the second largest player in that market has decided to walk away, not quietly, not slowly, but with intent. China holds roughly $850 billion in combined US Treasuries and agency debt when you stop playing games with definitions. Not just the headline Treasury number, but the full exposure that includes Fannie Mae and Freddie Mac, the backbone of the American mortgage system. That $850 billion is leverage. It is not power in the abstract. It is direct influence over interest rates, liquidity, and financial stability. For 20 years, that leverage was never used because the relationship worked. China sold goods, America consumed them, and the dollars China earned flowed right back into US debt. It was a closed loop, a self-reinforcing cycle that kept interest rates low, asset prices high, and consumers feeling rich. It was globalization's golden age, and it was built on one fragile assumption: trust. That trust is gone. The trade war of 2026 didn't just raise tariffs, it shattered the incentive structure that kept this system alive. When the United States imposed massive tariffs, it didn't just tax imports. It told China very clearly that the dollars they earned were no longer welcome on friendly terms. So China adapted. They stopped recycling dollars into US debt and started liquidating exposure. This wasn't emotional. It wasn't reactive. It was rational. If someone tells you they don't want you in their house, you don't keep lending them money, you take your money and you leave. And China didn't just leave, they prepared. They watched what happened to Russia in 2022, when hundreds of billions of dollars in foreign reserves were frozen overnight with the stroke of a pen. They learned a lesson that every non-Western central bank took to heart. Paper assets held inside the Western financial system are not really yours. They can be confiscated, frozen, neutralized. Gold cannot, land cannot, commodities cannot. So China began converting paper promises into physical reality. Month after month, record after record, they bought gold. Not ETFs, not derivatives, physical bullion. They brought it home. They stacked it quietly while the world argued about inflation, transitory narratives, and soft landings. At the same time, they began selling US assets, sometimes openly, sometimes quietly, through European custodians in Belgium and Luxembourg. The official data understates the reality, but the market feels it. Every rally in bonds is sold into. Every attempt at stabilization is capped. There's a ceiling on prices and a floor under yields, and that floor keeps rising. Here's the part most people don't understand. The danger isn't just that China is selling. The danger is that there is no one left to replace them. The Federal Reserve is shrinking its balance sheet. Banks are already overloaded with government debt they bought when rates were near zero and are now sitting on massive unrealized losses. Japan is fighting for its own currency and selling treasuries to defend the yen. Europe is fragile. That leaves one buyer, the domestic investor, you. And to get you to buy trillions of dollars in new debt every year, the government has to offer higher and higher yields. This is where the damage spreads into your life. Bond prices fall, yields rise. That is not an opinion. It is a mechanical relationship. When yields rise on the 10-year Treasury, mortgage rates follow. The 30-year fixed mortgage is not controlled by the Federal Reserve. It is priced by the market, and the market is demanding compensation for risk that didn't exist before. Risk of inflation, risk of monetization, risk of geopolitical retaliation, risk of sheer volume. If the 10-year yield pushes toward 6%, mortgage rates pushing toward 9% are not extreme. They are inevitable. That level breaks housing. Housing is not just shelter in America. It is psychology. It is collateral. It is the primary source of perceived wealth for the middle class. When rates rise, affordability collapses. When affordability collapses, prices follow. And when prices fall, the wealth effect reverses. People stop spending, credit tightens, layoffs begin, tax revenues fall, deficits grow, more bonds must be issued, more bonds push rates higher. This is a feedback loop, and once it starts, it feeds on itself. The Federal Reserve cannot stop this. They can cut short-term rates, they can talk, they can signal, but they cannot force long-term buyers to accept low yields when the supply of debt is exploding and foreign demand is vanishing. This is what fiscal dominance looks like. Debt volume overwhelms monetary policy. The tail stops wagging the dog. The Fed becomes reactive, not proactive. At the same time, the shock absorbers are gone. The reverse repo facility, once holding over $2 trillion in excess liquidity, is drained. That pool used to cushion treasury issuance, absorbing supply without blowing out yields. Now it's empty. Every new dollar borrowed has to come from somewhere else, and that somewhere else is the banking system itself. Banks already sitting on hundreds of billions in unrealized losses. Losses that don't matter until they do, until deposits leave, until bonds have to be sold, until accounting fiction meets reality. This is how banking crises are born, quietly, slowly, then all at once. And the attack doesn't stop at bonds. The dollar itself is being challenged from another angle. Energy. For 50 years, the petrodollar system forced global demand for dollars. If you wanted oil, you needed dollars. That created permanent demand for U.S. currency, and by extension, U.S. debt. China is dismantling that system piece by piece, paying for oil in yuan, setting up swap lines, cutting bilateral deals, encouraging settlement outside the dollar system. Every barrel traded without dollars reduces global demand for treasuries, reduces the need to hold U.S. assets. At the exact moment America needs buyers the most. This is a pincer movement. Supply pressure from bond selling, demand pressure from de-dollarization, and it leaves the U.S. with two choices, neither of them good. Print money to absorb the debt and save the system, igniting inflation and destroying purchasing power. Or don't print, allow rates to rise, and accept a deflationary collapse. Politicians will always choose inflation. History is clear on that. Pain tomorrow is preferred to pain today. That is why the stock market behaves the way it does. Rising nominal prices don't mean prosperity. They often mean currency decay. Assets float higher because the unit of measurement is shrinking. This is why bonds, once the safest asset in the world, have become the epicenter of risk. The 60-40 portfolio worked in a world of falling rates and stable geopolitics. That world is gone. The smart money sees this. Central banks are buying gold at the fastest pace in decades. Billionaires are buying land, resources, infrastructure. They are moving away from financial abstractions toward tangible reality. They are preparing for a world where promises matter less than possession. And this is the part that matters most for you. Wealth is not destroyed in these transitions. It is transferred from savers to debtors, from holders of paper to holders of real assets, from people who trust narratives to people who respect math. Inflation is not an accident. It is a policy choice, a hidden tax. And every dollar you hold is a vote of confidence in a system that is openly telling you it cannot balance its books. China understands this. That is why they are leaving. They are not emotional. They are not panicking. They are repositioning. They are trading claims on a future they don't trust for assets that exist now. And the rest of the world is watching and learning. The storm is not hypothetical. It is already overhead. You can feel it in higher insurance bills, higher food prices, higher borrowing costs. These are not random. They are symptoms, signals, warnings. The bond market is cracking, and when it finally gives way, the response will be fast, aggressive, and inflationary. The only question left is whether you recognize what is happening before the doors close, before the rules change, before paper claims are trapped inside a system designed to protect itself at your expense. The math is already written. The incentives are clear. The players have made their moves. All that remains is whether you stay where you are and hope, or whether you reposition while repositioning is still possible.